Well, thank you for having us here today. I'm so delighted to be on stage with Michelle, who I have followed her work for years. I'm the Sustainable Finance Editor at Bloomberg, as Karina mentioned so nicely. But before that, I was a corporate governance reporter for 10 years, so I've followed Michelle's work for quite some time. It'd be really great to, I'm looking forward to questions from the audience and hoping we make this an interactive session. But let's start at the beginning of the year, this year, where BlackRock really made a big splash with Larry Fink's letter that he sent out to CEOs. And it's an annual letter. He sends it every year. I've actually read it pretty much every year for the last 8 years. But what did he really touched a nerve with this one. I felt like at Davos, CEOs were like, what is happening? How has your job changed as a result of that letter?
Well, as you say, this letter has been sent in one form or another for 6 of the last 7 years. And the messaging has been very, very consistent that as a long-term investor on behalf of our clients, we expect companies to articulate their long-term strategy, how they're going on the path to delivering that strategy, and how they think about their business holistically. And then each year, Larry also comments on 2 or 3 global trends that he has sort of observed and that he hears through the conversations he has with various CEOs and government leaders and so on through the year. The thing that was different this year, and it really did surprise us, frankly, because we were wondering if this year's letter would even get that much readership, was in it we mentioned that companies have to articulate their social purpose. Now, we didn't think that was a particularly controversial thing to say. And it was certainly something that we thought was very consistent with this focus in business world to rebuild trust with the constituents that companies depend on to be financially successful over time. But what happened was there was a reaction to that phrase, social purpose, particularly in North America. Across Europe and most of Asia Pacific, the reaction was very much what we thought it would be, that we support this concept, we've been doing this ourselves for some time, this is a good thing that a major investor has said this. But in North America, it was more controversial. And some of the commentary was around the fact that we were perhaps using our clients' assets to pursue a political agenda that was different to our clients' interests and so on, which is absolutely fundamentally not the case. We truly believe that for companies to be financially successful over time, they have to be relevant to the parties they depend on to be successful. And that means articulating why you think your stakeholders or the constituents you depend on should continue to support you. And that's what we meant by social purpose. And interestingly to me, the conversations that we've had with CEOs and business leaders has been very consistent with our concept. They understand that day in, day out, the decisions they take have consequences for many parties beyond just the profitability of the company, and they are trying to be holistic in that decision-making. The people who seemed to be most concerned about it were often pundits who had strong opinions, but perhaps not much experience of running companies and taking decisions that impact others day in, day out.
So why do you think social purpose has become such an important thing for companies to get ahead? Why is articulating that valuable as an investor?
Well, I do think a key part of it is around rebuilding trust in business. But I think it is also just a more widely expected sort of positioning of companies from broader community than perhaps it was historically. And certainly, as society shifts and has different expectations of companies, particularly in the absence of government action on key societal issues, companies being able to articulate what they think their role is important to be sure that they're being relevant to the people who have an opinion about the company.
And have you seen any of your portfolio companies get more specific about their social purpose in light of this letter, or have they talked to you more about it? What's been you said they sort of understand it, but what's been the reaction there?
Absolutely. BlackRock has about 2,000 engagement meetings a year with companies around the world. And this year, social purpose has been one of the consistent themes through those conversations. And probably the most consistent message that we're getting back is we believe we understand our social purpose, but actually we are finding it quite difficult to articulate in a meaningful way that doesn't sound trite to outside parties who may not fully understand the business the way that insiders do. And I think that might be the sort of next evolution of the conversations we have with companies in the coming year, is how are they going along that journey of articulating their purpose for people who may not understand the company as well as the CEO and employees do.
Yeah. Well, some of that, it sounds like it's potentially about talent retention. A lot of millennials are very into, they'd rather work for renewable energy companies maybe than fossil fuels or that sort of thing. And so to get the best talent, maybe you need a social purpose. Have you seen that in your own business at BlackRock? You guys have been much more outspoken lately about climate and firearms and all these diversity, all these issues that sort of resonate with younger people, but your staff and social issues. Has that resonated with your own staff?
Well, the reason that BlackRock Investment Stewardship has these conversations around these core themes is because we see them as being key to how companies generate long-term financial returns. But on the corporate side, there definitely is a sense amongst employee base that it's important for BlackRock as a company, so from Larry Fink, our CEO, through the organization, to take positions on things that are relevant to our business. And we are a little bifurcated in the sense that what investment stewardship does, the team that I lead does, is purely around being a voice of the investor on behalf of our clients who are long-term investors, many of them invested in index strategies. But the fact that it also resonates with employees, I think, is a benefit. But what really resonates with employees is the way that BlackRock is led by our executive committee.
Yeah, and let's sort of crystallize for the group out there what you really do as head of investment stewardship at BlackRock. It's such a big organization. I imagine you're not filling out all the proxy cards yourself.
No, thankfully that is not what I do all day. It is a big job. So we have a team of 40 people around the world. We break our team up in regions because although the principles of good governance from accountability and transparency are pretty consistent globally, how that applies in different markets is very different, and what the key issues are in different markets is very different. The key governance issue in China right now is the transition from founding families to the next generation, and how do minority investors like our clients ensure that their interests are protected. Issues in Europe are different around board quality, board diversity, similarly in the US. But even between Europe and US, the nature of those conversations is a little bit different. And so we try to be locally present, but coordinate globally. And we have articulated 5 priorities for our engagement with companies, and the first being board quality, because in our view, it's hugely important to get the right people in the boardroom because that establishes the foundation for who's in senior leadership roles in C-suite and beyond, and the operational practices and policies that companies have in place that are consistent with long-term financial performance. So we're looking at board quality. A subset of board quality for this year and last has been board diversity. And in the absence of progress over the last few years, we wrote to the roughly 300 companies in the Russell 1000 that have fewer than 2 women directors, asking them to articulate how they were going to improve the diversity on their board, and signaling that absent progress, we may vote against the members of their nominating and governance committee. And we've seen real action there. And interestingly, from our perspective, the real estate investment trust sector was one of the laggards in that Russell 1000 cohort. And this year, over 50% of the new directors appointed to REIT boards were women. So I think, when people are deliberate about affecting change, they affect change. And that's been really positive. Another thing that we've been talking to companies about board quality is for companies that are carbon intensive, how are you ensuring that the board understands both the risks inherent in the business today and a transition to a low-carbon economy. And many boards are really not well equipped for that today, and so we're engaging companies about how they are addressing that gap, if you will. Then other issues are articulation of long-term strategy, which has been a long-term focus, the alignment of executive compensation to delivering that long-term strategy, disclosure of climate risk for companies where that is particularly relevant, in alignment with the Task Force on Climate-Related Financial Disclosure, and then finally, human capital management, and how companies are ensuring that they are an attractive employer for top talent that they depend on to generate sustainable business over time.
It's really interesting to hear you say how you guys vary from region to region and country to country in what you do. How do you sort of communicate that? You know, how do you say, well, we think 2 women on boards should be the standard in the US, but not in Japan?
Well, in Japan, fewer than 1% of directors are women, so 2 would be quite a stretch. But it's not that there's any magic around the number 2. It is that, you know, if you put out too high a target, companies are going to say it's unachievable. If you make it too low bar, then it's a token. And so, you know, the point is we want to see progress. In most of continental Europe, companies have either got to meet a government and stated quota or a best practice target. And so there's not as much need to engage there because there's a market level push, if you will. In Japan, the issue is slightly different around board quality. There's a real focus on independent directors. Now, in Japan, independent directors are a very new thing, and we think it's important that companies determine for themselves in the Japanese context what it means to have an independent board director, because consensus is very much part of Japanese culture, and it's a little bit alien to say these people have to be independent of the others. And so how does that work in practice, and are we sure that we're not putting in place a governance or a power balance mechanism that actually isn't effective because no one understands what it is?
And how do you communicate that, I guess, to your investors at BlackRock?
So we have a lot of information on our website. We set out our priorities on our website. We also have a more fulsome explanation of how we engage companies on those priorities so that companies know what to expect when we say that we want to talk to them about one of those issues or several of those issues. And then for clients, we publish a quarterly report around our engagement and voting activity so they can understand the breadth and depth of the work that we're doing. We anonymize most of the case studies in those reports because we are a long-term investor. Our clients are going to be investors in these companies well after the current management team has moved on. And so we're trying to build long-term relationships based on sort of a mutual understanding that the feedback we're giving is because we think companies could be doing a better job. And we want that to be based on trust and confidentiality. So we do outline the work we've been doing, but we anonymize it. But actually, relatively informed observers can make an educated guess about which companies we're talking about.
That's true. I've definitely been able to guess myself when I read them. I was like, oh, that one's Exxon. But yes, so on that note, you know, one thing that's really interesting about BlackRock is that you have a ton of funds in passive and a ton of funds in active. And how do you balance the needs of both those investor groups in your stewardship? And then also, how do you how do your clients from each group input and give you input on what they'd like you to do, or do they?
So I'm going to answer the first question first. And if I forget the second question,
I'll bring
remind
it
me,
back.
because I'm memory like a sieve. The way that investment stewardship engages at BlackRock is that we're agnostic as to where those holdings are held. But it's important to know that of the a little bit over $3 trillion that we invest in equities on behalf of our clients, 90% of it is an index. So the assumption is always that the biggest part of our holding in any company is going to be an index strategy, so long-term, locked-in, patient capital. Where we also have an active holding, we talk to portfolio managers with those holdings about their views on company management, on financial performance, on any operational issues that they think the company needs to focus on differently. And that informs my team's engagement. But across BlackRock, we're trying to take a consistent approach to the messaging that we give companies. There's, broadly speaking, a long-term bias on our active investing side as well. And so we're very confident on the investment stewardship team that when we talk about BlackRock's views on what are the key issues over time, that will be consistent with what active managers are also thinking.
And so when you think about this, the question was your clients, the follow-up question was
no,
whether your clients have any input.
And in terms of client feedback, we get feedback regularly. It does help inform our thinking, but it's important for this audience to know that we have a very broad spectrum of clients. And at one end, clients want us to be very actively engaged with companies. They really see investment stewardship as a core part of investing. At the other end of the spectrum, we have clients who actually think this is probably a waste of time and it's inconsistent with index investing in particular, because index investing is just about returning the market, and it doesn't matter what quality of companies are in the index as long as you return the market. And in the middle, we have a pretty significant group of clients who haven't expressed a view. At the same time, a slightly different spectrum, we have clients who have very strong views on certain issues, and clients who also have very strong and opposite views on certain issues. And this brings us back to this middle point of everything we talk to companies about, we see as being aligned with their long-term financial performance. Because the only thing that all our clients have in common is that they've entrusted their assets to BlackRock to generate a return so that they can meet their financial goals. That's it. Clients who want to choose to invest in a specific fund because it might exclude certain companies or sectors, or it might overweight certain themes like energy technology, water technology. We have those types of products that clients can invest in. But absent that choice on behalf of clients, everything else that we do is because we believe it generates superior financial returns.
Yeah, well, let's dig into some of those issues that you guys have faced this year at BlackRock, which I've definitely been writing about at Bloomberg. I know I called earlier this year, and I was calling about climate change, and you're like, we're so busy with firearms, we haven't even thought about climate change this week. But that was after the Parkland shooting, where obviously a lot of teacher pension funds realized they were holding shares of firearm makers they didn't want to hold, and you guys fielded a lot of inquiries immediately saying that, you're some of the biggest holders in some of these firearms companies, and how are you going to push these companies to be more responsible? So how did you get to where you landed, and what was the process you went through this year?
So we made we made a public statement about the engagement that we would do with companies in our portfolios that were involved in either the manufacture or distribution of civilian firearms. And it was very unusual for us to make a statement about something so topical and sort of in the moment. But one of the reasons we did is that so many people were speaking on our behalf and saying, BlackRock is doing this, BlackRock is doing that. And we felt it was important to articulate what it is that we actually were doing. And we did engage with the majority of the companies that we invest in that sector. And the nature of those conversations was generally with board members as well as executive committee members to discuss how they saw that incident affecting the way that they run their business, and then understanding how they judge the risks and opportunities in their business, how they see legislation changing that may affect the way that they set their long-term strategy. And most of those conversations were very, very constructive. There was one company that has a policy of not engaging with shareholders, and they also had a shareholder proposal on their shareholder meeting agenda about a disclosure around firearm safety, and that passed with a majority of votes simply because that company wouldn't engage investors and explain how they were thinking about their business.
And in that case, you had clients who were all over the spectrum on what they would have wanted you to do in that scenario. So how did you balance your clients' desire to say, I don't want BlackRock doing this, I do want BlackRock doing this?
Well, again, we brought it back to how does this development affect the way that management think about their long-term business management and operations and processes, and how is the board overseeing management to ensure that management's taking the right approach? And interestingly, from my perspective, we had a lot fewer inquiries from clients we would have expected to be supporters of further gun reform or firearms reform, and many, many more conversations with clients who were, as they would say it, supporters of the Second Amendment.
Interesting. And then I guess another long-term issue, we'll switch gears to the other one I called about before, firearms, is climate, because you keep saying you're long-term investors, you're really focused in climate, and the UN report came out this year, just recently, a few weeks ago, saying, we'll start to feel effects of this by 2040. We've sort of already lost the battle for 1.5 degrees. And sort of, I've heard investors all over this space have sort of a renewed sense of urgency after that. Do you have that urgency at BlackRock? How do you see your role in that climate change battle? So
since the Task Force on Climate-Related Financial Disclosure, TCFD, if everyone's got that in their mind, so I don't have to keep saying that long and quite complicated sentence. Since the TCFD draft recommendations came out, we have been actively engaging with the companies that are most impacted by that framework, asking them how they plan to review the recommendations and then potentially evolve their disclosures. Because I think it is a very thoughtful framework, and one of the most important things about it is it does align with how companies are run. Talking about governance, strategy, metrics, and targets. And so that's one of the core conversations we've been having. But we have also been having conversations about how companies are adjusting their asset mix to reflect this long-term transition to a low-carbon economy, and what companies are doing in terms of things like preparing for technology change, preparing for regulatory change. And most of the largest oil and gas companies, and we're not just focused on oil and gas, but just land on that sector for a minute, are global. So a change in policy in any one administration doesn't necessarily affect the fact that climate risk is global. They are global, and regulations in other markets affect their business as well as regulations in their domestic market. And so that's the nature of the conversations we've been having across the board. But it isn't just with oil and gas companies or the most intensive extractive industries companies. We've engaged with over 250 companies globally that will be impacted by climate risk and changes around climate risk.
So I remember writing, maybe even breaking the story a couple years ago about BlackRock's first climate vote, support of a shareholder proposal, which is sort of a new spot for you to find yourself in climate. How have you adapted to that? And I think the percentage that BlackRock's supporting is probably around 16%, but what the analysts say. I think Sirius does that report. But why not 100%? What are you balancing in your engagement with companies, and how are you communicating with the broad investor community, really? I feel like they have a lot of questions about what BlackRock's willing to take a stand on in climate.
So our approach has always been engagement first, and by that we mean we want to speak with companies at management and board level about the issue of focus, so in this case climate risk. And if we think companies are responsive and going to change and perhaps in climate risk disclosure context disclose more, then we give them time to do that. Where we think companies are not moving fast enough or have paid lip service to being responsive, that's when we will vote against management. And I think it's important to reflect on the fact that shareholder proposals are relatively specific to US market, and we engage globally. And we've engaged with many, many, many companies on this issue that have never had a shareholder proposal because they're not in the US, and even US companies that have not had a shareholder proposal yet, often because they're not household name companies.
And so when you vote, how do you decide when you're going to take a stand on climate?
Well, we're not taking a stand on climate, we're taking a stand on the company's responsiveness to the issues we've raised with them. And it's really when we believe we've given them a reasonable time frame to do something different, and they haven't done something different, or haven't done enough in our assessment. And we give them that feedback, and then we vote against management. And again, when there isn't a shareholder proposal, you vote against by voting against directors. We see directors as being the key channel for accountability for shareholders because that's their job. They're meant to represent the long-term interests of the corporation, and we take that to mean, in part, the shareholders. And we see that as the conduit for us influencing the way companies think about these things. And boards hold management to account in turn. So if the board understands that we are expecting more from the board, then we expect that to cascade to them being clear that the board expects more of management.
Yeah, and it's really interesting that you guys have definitely done these votes against board members, which I think sometimes people take by surprise or don't see as clearly, but you've definitely made some huge statements the past few years on votes against board members. And that sort of raises a good question. When companies set these sustainability goals, increasingly you're seeing them out there. What's BlackRock's role in sort of holding those companies accountable? In many cases, you're the largest shareholder at all these companies. And if they set a goal and they don't meet it, what do you do?
Well, first we engage, and it's to understand why they didn't meet it. This is a long-term transition. If we're talking about climate risk, there are other changes that companies are making. And really, when you're making fundamental change to the way you do business, that takes time. I'm going to go off on a little tangent for a second, and it's outside US, but we've been engaging with a number of companies in emerging markets involved in food production and where there is a history of and current practice of bonded labor. Their business model depends on bonded labor. We can't expect them to honestly do away with bonded labor overnight, but we do expect them to adopt policies and start to evolve their business practices over a reasonable and defined period of time so that that is not part of how they do business anymore. And when you're expecting really fundamental change in the way a company does business, you have to be patient, but you have to be persistent, and we're definitely persistent. So we monitor what companies are doing against the things they said they would do. And if we think they're not making progress because they paid lip service to making any change in the first place, that's when we would vote against management.
Yeah, this actually goes back to Larry's letter a little bit, where he said that concept of our patience is not infinite,
Yeah,
right? And
exactly.
how does that play out? Like, when does your patience run out?
There's no time limit. It's not like after 6 months or 12 months or 24 months. It is in the context of the change we expected and the change the company committed to, absent, exogenous shocks that mean the company couldn't make the change, and that can happen. But it's always case by case. And that's the nature of the work that we do. It is case by case because each company is facing a different set of circumstances.
So could you talk a little bit, sort of back to your overall theme of what you do? Because BlackRock is in such a unique position, holding $6 trillion in assets. You hold the whole market. I mean, how do you balance, fighting for climate change preparedness on one end and then investing in fossil fuel companies in the other? I've heard people say, are you a hypocrite? How do you balance that? I'm sure that you've been asked that question more than from me.
Yeah, just to be clear, BlackRock doesn't invest in oil and gas. BlackRock's clients invest in oil and gas. That is their choice. And if every single one of our clients said we want to invest differently, then we can facilitate that. But as long as they choose to invest that way, that is the investment that we will do on their behalf. And so on behalf of our clients, BlackRock is a very big investor in oil and gas, but we're also a very big investor in renewable energy and renewable technology. And so some clients have made a certain choice to invest in one way, and other clients have made a choice to invest in a different way. And so the reason that we engage with companies is to ensure that companies in whatever sector are adopting business practices that reflect the reality of their business future, and that's because our clients are long-term investors.
And when you think about that, I mean, holding the whole market globally, it's such an interesting concept given how political things have gotten in the past few years, and fights between different countries, and just recently the Saudi Arabia issue over the journalists and a lot of investors pulling out of that. I mean, what you do with companies, does that extend to sovereigns, or how do you think about your responsibility and your social purpose at BlackRock when you're invested in different places around the world?
Well, I mean, I don't speak for BlackRock Inc. as a corporation. I'm purely representing BlackRock as an investor in public companies. But the leadership of BlackRock is very focused on what our own social purpose is, and that is clearly articulated as building a better financial future for our clients. And the extent to which our business sometimes leads into situations like being part of a convention in Saudi Arabia at a time when there's a very uncertain development. That was a corporate decision for Larry Fink not to attend. But as he said in a TV interview he did shortly after that decision, and has subsequently said, none of these issues are simple or black and white. And anyone who portrays them to be black or white has never taken that decision. They're difficult decisions. And the framing in which he takes those decisions, or our executive committee take those decisions, is what they believe to be consistent with BlackRock Inc.'s responsibilities.
And do you think BlackRock can continue to navigate in this sort of gray area world and say there's a lot of complexity out there when people really around the world are asking for sort of, think, no, this is right, this is wrong? We're hearing a lot more of that even from employees.
But anyone who thinks there's a single right and a single wrong is trying to put their views on somebody else. I just don't think that that's a realistic way to live. You can have your own sense of right and wrong, but I don't think there's a global reality there.
That's fair. Get your questions ready. We'll have a couple minutes for questions. Yeah, and I had one more question for Michelle, but I just wanted to tell the audience to get their questions ready. Our last question, I thought we would talk about what you guys have done on diversity this year, which has been really fascinating to see BlackRock write letters to so many companies about why don't you have women on your board. What's been the response? You mentioned it a little bit earlier, what you've done in that space, but what's been the response from companies to that? And do you see yourself doing more of that kind of engagement in the future?
I mean, we've done thematic engagement before, but absent writing letters. And the reason we wrote letters this time around board diversity is we've had hundreds and hundreds of conversations with companies about board diversity, and yet they seem to have sort of gone into the ether. And there's something very tangible about writing a letter, and that, I think, makes a difference. Similarly, on our engagement with companies in the civilian firearms sector, that was a matter of urgency because we wanted to have those questions in front of the companies so they were clear about what we were doing and were therefore able to prepare for the engagement that we were seeking with them. And the balance between dialogue, bilateral dialogue and letter writing just depends on how broad-based the issue is.
Well, we do have some questions from the audience.
I think Karina's going to come up and do it.
Oh, Karina?
Do you have them?
I do have them.
Okay, great.
But I can start with one, and maybe we'll tag team. So I think the first one was actually really interesting. It was, Michelle, given that BlackRock has said they're doubling the size of the stewardship team, what are your priorities now that you have more staff on hand, and how is that changing what you're doing?
So our priority, which was outlined in Larry's letter earlier this year, is to have more and more strategic engagement with companies. So less focused around proxy voting, which is a very high volume activity and a very important activity, but more focused on these conversations with companies around their long-term strategy and the long-term drivers of value and risk in their business. And engagement with companies, particularly in those bilateral conversations, is a matter of having the people who are able to sit down and have that conversation and prepare for that conversation and understand what it is they're being told by companies and whether that's a credible response. And so it's really doing more of the same, but more broad-based.
Great. Karina?
All right, I've grouped a few of these questions. We got a lot of questions. Thank you so much. All right, so what was Larry Fink's epiphany in demanding that portfolio companies define their social purpose? Do you know?
I can't speak for the epiphany moment because I don't think I was there. But as I mentioned, one of the inputs into Larry's letter is the sense that he gets from all of the conversations he has through a year with all of the people he interacts with, whether it's our clients, other CEOs, government leaders, and so on. And there just seemed to be a real coalescing around what is the purpose of business, particularly absent leadership on political government. And therefore, is there a need for business to step up and take on more than perhaps it was traditionally expected to do? And that was what he was articulating in the letter, is companies need to have a social purpose and they need to be able to explain what that is, and so that they can get feedback from the parties that they depend on to be successful over time and perhaps evolve their sense of purpose.
And there was a question around what is BlackRock's social purpose, which you did articulate in building a better financial future for clients. Has that changed since this expectation has been set with the rest of the market? Should it change?
I think it will evolve, but I think that's core to who we are. We're a fiduciary investor. We have a very, very strong sense of fiduciary duty, which is a duty of loyalty and care to our clients. And helping them build a better financial future is what we're good at. We're good at the risk management side, we're good at the investment side, and we're good at engaging with clients to understand what they think their financial future should be and how they want to invest to achieve it.
Another great question on here. Thank you. Michelle's being such a great sport, like really being very open about all of these ideas and questions. Another question on here was, if you don't divest from companies from bad behavior, right? And I've heard this all across the market where they say, well, why should I care about what long-term investors think, because they're just going to hold my stock anyway. So what's your carrot and stick for negotiating that with companies?
So, BlackRock clients can divest from companies by investing in certain products which don't invest in those companies. But we can't unilaterally divest, certainly not in the index. And voting against management actually has a really quite impactful reaction from management, because management expects support. And when they get that negative feedback through a vote against management, they really want to understand what's behind it and what they need to do to get support in the future. And particularly when they get a vote against management, not just from one or two shareholders, but from a very significant majority or a majority, a very significant portion or a majority, there's a very clear signal that there's a gap between what management is doing and what shareholders expect, and that's important feedback. I would say that on the whole, companies that get that level of negative vote have not been listening to shareholders up to that point.
So one of the questions here was, at what point do you divest? But it seems like what you do with the firearm funds or that sort of thing is you create products that allow your clients to not hold the index.
It's for our clients to decide how to invest, and we give them choice about how to do that. And then through the engagement for the clients who choose not to divest, we try to encourage companies to adopt the business practices that we consider to be aligned with long-term financial performance.
Karina?
We have several questions around the S of ESG. Clearly, we've been talking a lot about G, it's all related. So in terms of board diversity, you mentioned the importance of board quality and board diversity. When you ask companies about this, what sorts of responses do you get when you asked how are companies going to increase board quality and board diversity. And I'll ask another S question as well. Does BlackRock view income inequality as a political issue or a material stakeholder issue?
Sorry. So on board diversity, frankly, some of the answers we get are like from the 1880s as opposed to the 1980s or even the 2018s. There aren't any qualified women, we don't need a woman director, we're not a consumer-facing company, and so on and so on. And that's one of the reasons that we wrote the letter, because we'd had too many of those kind of responses. It's not till you're clear that there are repercussions for not being responsive that we think the discussion has changed. And again, just to use the REIT sector as an example, we had some of the most spurious responses from companies in REIT sector, and yet clearly they could act when they chose to. And this was independent research done on the REIT sector board appointments. And I'm not saying that's because of our letter. Lots of investors have been raising board diversity with a broad swathe of companies. I think probably the most important thing from our point of view is that companies introduce a formal and robust process for identifying director candidates for their board. Because anecdotally, 80% of board appointments are made based on the incumbent director's network. Now, that's not necessarily a bad thing. Boards are a sort of very unusual, organic little group in the sense that they don't meet very often, but they take very big decisions together, and they have to form a bond of trust that really is effective quite quickly. So they want to have confidence that anyone new they're bringing into that group is going to be a constructive and contributing member of the group. But if networks of the incumbent directors are not diverse, inbound directors are not going to be diverse. And so one of the questions we ask is, how are the incumbent directors ensuring that they're diversifying their networks? But also, how often do you really seek director candidates in new and unusual places? And how often are companies bringing in, committing to develop a director who has never been a director before? Because frankly, it's a little bit of free riding if all you ever do is recruit directors that someone else has trained. And so there's a lot of work to be done, but one of the things that we found most frustrating was this answer, oh, we don't know any women directors who have experience of being a director. We don't know any women who have experience being a director. Every man was a first-time director once. Someone took a bet on an untrained director who happened to be a man. You can take a bet on an untrained director who happened to be a woman.
And there was the income inequality question.
Oh, pardon me. Thank you for reminding me. On income inequality, I think it's more than just, is it a political issue, is it a business issue, is it a societal issue? It's all of those. And business plays a role, and one of the conversations we have with companies that have a business model that depends on employing relatively low-skilled, low-paid workers is how they are ensuring that they're not free-riding on government to have the business model that they have, how they are ensuring that they are paying their workers fairly and providing benefits and a career opportunity consistent with what is really sort of what people expect in today's world. And there are some big gaps, and many of you may have seen the New York Times article about miscarriages of women working in a logistics warehouse, which is the sort of thing that no one expects to read about happening in the US. And that's part of the conversation we have around human capital management and being an employer of choice. And people think that human capital management in that context as being how does Amazon attract the best people or how does Google attract the best people, but it's across the spectrum. It's not all about top talent coming out of top quality graduate schools. It's people across the spectrum. And you see it right now in a very tight and constrained labor market, how many job ads there are for people who, loosely speaking, are relatively low-skilled, but there aren't enough of them in the workforce right now.
That's a really interesting response. one of the questions on here that I thought was really interesting was how are you using MSCI, Morningstar, all these ESG, Sustainalytics, ESG ratings, and also similarly the proxy advisor recommendations, how do you use both of those and how do they integrate together?
So they're slightly two different questions. I'm going to go with the proxy advisor first, because it's a relatively straightforward answer in the sense that we use both of the key global proxy advisors, ISS and Glass Lewis, in our process. We use one of them as a vote execution platform as well as a record-keeping platform and so on, and we take the research from both of them. The research is one input, and we use them as data aggregators because the disclosures that companies do, even though they are broadly the same, the formatting and the focus is very different company by company. And what the proxy advisors do is they aggregate that information into a very consistent template, which is important for us to be able to access it quickly and predictably. That said, when we identify issues, we look into the information that the company has published, into our own records around engagement, and talk to our portfolio managers if we have active holdings. We don't follow the recommendations of any one proxy advisor. And because of some of the headlines around, index investors only follow the proxy advisors and so on, which we wholeheartedly refute, we did a paper published earlier this year over the summer called The Investment Stewardship Ecosystem. And in that, we set out the proxy voting record of the year to June 2017 of several of the large investors and how ISS had recommended. And it shows that on the vast majority of proposals which are routine, there is a fair amount of consistency in the sense that we vote for management. Everybody votes for management on routine things. When you look at shareholder proposals, there's a great variation in how investors vote compared to ISS and how investors vote compared to one another. And that's on our website if anyone wants to take a look. On the MSCI, Sustainalytics, et cetera, again, they provide data. Some of that data is entered into BlackRock's risk management and investment management platform called Aladdin. But it's one input, and more than anything, what we use it for is to create a flag for outliers, and then we look more closely, again, at what companies produce and what investment bank research might say about particular companies' performance on key dimensions.
If I could ask one question around, actually two questions around the theme that you mentioned, Michelle, that the problem of people, media speaking for BlackRock when there's increased headlines. So there's a couple things that we had questions for you to respond to. One is, you address the fact that BlackRock is essentially the largest fossil fuel owner, and you say, well, it's our clients who own the fossil fuel companies. But what's your answer to, well, this does make BlackRock perhaps the largest polluter or contributor to climate change? Is that your clients are the contributors to climate change, or is there something more nuanced there? And a related question, because this gets to your clients, you say only some of your clients choose to invest in a different way rather than the entire market. You engage with companies, but how exactly do you solicit client input? Do clients need more information in order to make informed choices about their positions?
So I'll answer the client part first because I think it's inherent to answering the first question. We do engage clients around a range of issues that they bring to us, but we're not the only party advising them. There are pension fund consultants for the institutional investors that are pension funds. Many conduct their own research. For retail investors, there are a range of resources. And so when clients come to us to have that conversation, we're available to have it, but we're not the only input into their decision. And I think there's a real gap, really, still in the way that people think about investing and the impact they're having through their investments. And there are a lot of people who have a 401k who couldn't even tell you what strategy that's invested in. I I mean, hand on heart, how many people in this, you don't have to put up your hands, how many of you could say, I have a 401k and these are the 3 funds it's invested in and I'm wholeheartedly confident that those funds invest consistent with my personal beliefs. And I think that's an evolution that journalists can help change, and suppliers and vendors help change, and just general discourse helps change. But it's not a change that happens overnight. On are we the biggest polluter? I mean, people can make that argument, but I think it's also incredibly nuanced because it isn't our choice. And if clients, like I said, were all to decide to invest differently, we can enable that for them. I just don't see that happening near term.
And just to wrap up, because this was such a wonderful, wide-ranging discussion, we had a great question from the audience that said, if you could write a letter to the CEO, given your years and years of experience in this, what would you put in a letter to CEOs today?
I just would like people to know that Larry doesn't write the letter all by himself. There's a very big influence on it, but there are a team of us who participate in it, but that's one thing I would say. In terms of what I would put in a letter, I think to companies, engage in the process. Too many companies, particularly when they're getting feedback they don't want, they hunker down and put up barriers. And these are not the companies in the leading edge of their sectors, but there are a lot behind that have a meaningful impact on the economy and society. But I do think companies that complain that a service provider to investors is not representing the company accurately, or that a standard-setting body is taking the standards in the wrong direction, make sure you're engaging with those parties and sharing your views and sharing your expertise, because otherwise nothing changes.
Well, thank you so much for such a wonderful discussion. It was really nice. Thank you.